Welcome, everybody. Good afternoon. So we're doing today chapter 9. We're skipping 8. We're skipping completely payroll. We're going into the end of the year cycle. Computer accounting chapter 9 discusses adjustments. So end of the year, what is the accounting cycle and what should be done at year end? Of course, adjusting entries. So chapter 9 covers adjustments. It's adjustments that are needed before you're doing any financial statements. Okay, so we're discussing the accounting cycle in this chapter, which is chapter 9. You're using QuickBooks and you're going to make adjusting entries. We will see the flow, how do you do it, and type of the adjusting entries. So you did learn adjusting entries in financial accounting, but it's just kind of you're going to do it online. Okay, so the accounting cycle is repeating every 12 months. The accounting cycle is a series of activities that we do all the time in that accounting period. So that's in the next 12 months. So we always start with chart of accounts. The chart of accounts is also your general ledger. That's the structure of the company. After we have the structure of the company, you could do transactions like write a check, enter a bill, make deposits. Those are transactions. After we do all the transaction, we want to make sure that the work is right, your debits and credits, and the accounts looks good. They're in the right area. So it's going to be you're confirming that by a trial balance. You're preparing a regular trial balance. After you have a trial balance, from the trial balance at the year end, you're printing it at December 30th or 31st. And you're going to prepare adjustments. So adjusting entries are a product of looking at the trial balance, realizing that some expenses are hiding in assets. Examples, the prepaids. So we have to inspect the prepaids. So you really have to do, first of all, the best idea is a frequent trial balance every month. So just to see if there's anything off. Before your accounts receivable, instead of debits being credit, that's already something that you should take care of right away, not wait for 1 year, not at the end of the year. Other adjustments are really just fixed assets and realize that they are depreciating and we need to depreciate them. So of course, adjusting entries is depreciation. You have also depletion and you have amortization. All that could be done at the year end. Then after you did the adjusting entries, you have adjusted trial balance. And from the adjusted trial balance, you go to the financial statements. So before adjustments, if you're printing financials, the financials are wrong. They're not accurate. You're going to have more assets and less expenses. So it's definitely not accurate before adjustments to print any financial statements. It's only after. Trial balance lists all the accounts. So the trial balance is very long because you have assets, liability, equity, also revenue and expenses. If you closed your accounts at the beginning of the year, your trial balance is shorter because that's post-closing trial balance, and post-closing trial balance does not have revenue and expenses. They're all zeroed out. So once a year the computer closes the accounts for us. So you need to prepare a trial balance to verify debits equal credits. That's the purpose of a trial balance. And from the trial balance, you're also looking at the account, examining them, and realizing which accounts needs to be closed at year end. So make the accounts, make adjusting entries using QuickBooks Journal. You have to do it in Journal. There's no icon for this, so you have to do it from menu. There's 2 ways of doing it in menu. It's just easier to find it under accountant because you'd realize that most accountants do journal entries. And that's the reason you're going to remember accountant, make journal entries. Another way is under company in menu. So the next one is company, make journal entries. So you have to find them in menu, accountant or company. Okay. If it's easier for you, remember journal entries. So this is that year-end cycle that we're doing today. Adjusting entries are often necessary when accrual basis of accounting is used. Of course, we're not doing cash basis, so we only work in accrual, and that's the reason we need it. Accrual means record revenue, income when it's earned, when product and services are provided to the customer. regardless of when the cash is received from the customers. So because of accrual basis, we need to examine on December 31st, did we work for anyone? We didn't send him a bill, an invoice it means. So on accrual basis, it's time to do invoicing at year end for shipments that just left the warehouse already on December 30, 31st. It belongs to that year as income. So that's accrual basis. You have to know when it's earned, not when cash is received. And the expenses are the same way. We record expenses when they incur. So we have to look at all the bills from December and make sure that December bills are in. Otherwise, your expenses are too low. And it's not cash value. We don't do cash. Cash is if you pay it in February, it doesn't matter. Your credit card bills have to be in because it's the date of the usage. So when the bill incurred, when the purchases happen, not when we pay the bill. So always important dates are check the end of the year to check all the bills that are entered. Now you cannot do this exactly on December 31 because bills come later. So I can get my credit card bill on January 15, but it's really December billing because if the inside all the purchases were done in December, that's your December bill. So we can't close the books exactly on December 31 because bills are coming still for December. That's rule number one. So year-end procedure, if you don't know how to do it, QuickBooks decided to help you. They will show you help in a minute. So accrual basis, you're going to look at 4 different types of adjusting entries: prepaid items, items that we paid in advance, but already some of it expired or sometimes all of it, like prepaid insurance or prepaid rent. If you paid for December rent with January rent, December is used up by December 31, so 1 month expired. So you have to move from prepaid rent to rent expense. Okay, so it's only adjusting entries are never involved cash. I'll say it again. Adjusting entries are never involved cash, which means checking. You're only going to look at items that needs to be adjustment between an expense and usually a revenue, a liability or an asset. An example liability will be unearned becomes earned. So unearned items are liability. You provided the work, so you earned it. So it moves to revenue. Item that a customer has paid for, but we have not provided the product, that's unearned. You have to look at those. Did the unearned become earned and move it as an adjusting entry? Accrued expenses, incurred, it means happened, but not recorded. Example of accrued expenses is usually salaries expense or interest expense. The time passed until the end of December, you did earn interest, but interest expense was not recorded. So you're writing interest expense, but you didn't pay for it yet because it's only going to be paid, let's say in March next year. So that's going to be interest payable. Accrued revenue. Revenue that had been earned, but not yet collected or recorded. So you have to send invoices, and that increases usually account receivable and revenue. So we're not telling the customer, oh, you just owe us $1,000, pay it today because we worked for you today. We send him an invoice for $1,000. He will pay it somehow next month in January, but we have to make sure that all our invoices, all our revenue is in for this year. Okay, otherwise we have a problem with the shifting income to the next year. So adjusted trial balance would have 6 columns. You have a debit and credit for the regular trial balance. Then you have 2 columns called adjustments. And then the next 2 columns called adjusted trial balance. Okay, so it's also the beginning of a worksheet, if you remember worksheet. So QuickBooks prepare the beginning of a worksheet, and from there you have financial statements. It goes into income statements, which is profit and loss, and the balance sheet. Okay, so now I'm going to show you QuickBooks and you'll see the help that you get. I stopped sharing for a second and I'm going to share QuickBooks. Okay, so this is QuickBooks. I don't know which company I opened. Okay, so it's an example of consultant. I think it's a new company that I do. Okay, not good. I didn't do anything on this one. Okay, but I could show you what I want. Anyway. Okay, so basically I go to the help. I told you QuickBooks decided that a lot of people are users and not accountants, so they do need help. We go to help, and we're talking about year end the whole time. So there is a year end guide. Now it's not going to do it for you, but it's going to let you do check marks as you do going on, reduce, making check marks as you complete the task. So you have over here a task for what should be done at year end to prepare for filing taxes. But it's not to just filing taxes, it's to prepare before you're preparing financial statements. Otherwise your financials are wrong. So tasks to prepare for filing taxes. They're reminding you what must be done. Some of it should be done every month. So A, B should be done monthly at year and every end of the month, but for sure at year end. Okay, so number A, excuse me, reconcile all bank and credit cards accounts. Okay, so reconciliation that we learned on checking, savings, all bank accounts needs to be done, and credit card accounts. So credit cards are very important because the credit cards usually you're missing the purchases of the month of December. So you must do up-to-date credit card. It doesn't mean to pay it now. It just says to enter the billing, the information about the credit cards. Then you have verify petty cash entries for the year. Again, petty cash needs to be replenished at year end because you're missing expenses if you didn't do it. So expenses are going to be debited and you're writing yourself a check, but it's not an adjusting entry. It's replenishing the petty cash because my drawer is open and empty. Then comes the year-end accrual. So year-end accrual is the topic that we're talking about today. Don't worry about D because closing the books, the computer does for you. So A, B, C, you really should be doing it very carefully. Now E, you again don't need it really. Adjust retained earning is most of the time what they're talking about here is for partnership when they have to split the money between partners. But otherwise you do not need retained earning. Your net income goes automatically to retained earning in a corporation. So again, you will not need this only manually when it talks about partnership. Review details of the new equipment purchased during the year because they want to make sure that you did the adjusting entries right. And then make the depreciation entries and the adjustments again. Review fringe benefits. This is related to all your salaries and payroll. Take physical inventory reconciliation with book inventory. Now, the reason it's separate over here and it's not inside make the year-end accrual, and the reason is you have for inventory, okay, I chose the wrong company. I don't even have inventory. I'll have to close and open another company. Just a minute. I want you to see where inventory is. Okay, so let's open, I'll open RC Construction. Okay, so our year end is December 31, 2022. That's my year. Today's December 15, according to the computer. That's a simple date. But we have to remember 2022, not to change the year. And I want to talk about the home screen. Okay, so the home screen shows, let's maximize this. Okay, when we talk about inventory, you have right here inventory activities on the top. And in inventory activities, you will have adjust quantity value on hand. So you cannot do it as manual accounting, just debit cost of goods sold and credit inventory. It's not going to work because it's not physically changing the numbers of inventory. So you're really doing the journal entry based on which inventory piece you don't have. An example, Okay, so inventory adjustment works like this. It's based on the quantity. Let's say I know that on December 29, I don't have to wait exactly to December 31st. I can do it whenever I need. You can make it into cost of goods sold. You can make it into selling expenses, things like that. But definitely this is going to be my debit, cost of goods sold. And whatever I'm choosing in here would be your inventory asset. So let's say I went and I counted my doors. Okay, so I went to the doors, exterior door. Exterior door, the value is here. Average cost, 308.51. Quantity on hand is 15, but I really counted, new quantity is 13. Why? Because 2 doors are damaged on a job. So I want to write down the memo. 2 doors were damaged on the job. Okay, so 2 doors we can't use. And this is an adjusting entries, and it shows you the total. So what it did before is taking the average cost. It took the cost of 308.51, and doubled it, 617.01. That's the -2, which we see here. And you're going to have an adjusting entry on that date. I can also do it on December 31st, but that's an adjusting entries. If you want to relate it to a customer, you could choose a customer. Where did it happen? You could choose a customer name. Okay, but what's important is if you broke something or something is damaged, you can adjust the quantities because you want the computer to be up to date. So if a customer says, can I order 17 doors? I'll say, no, I'm sorry, I only have 13 in stock. So I need to know when to order. Okay, so all this is up to date, and this is the correct way to do inventory. You cannot do this journal entry, control and say make general journal entries. I want you to understand why not. It's not wrong in accounting to say cost of goods sold, $617. I can forget the penny. And merchandise inventory. Inventory asset going down to damaged doors. Okay, obviously you'll see that here it's not going to the specific inventory. And that's the reason you cannot do adjusting entries of inventory this way. Even though your date is right and the accounting is right, it does not say which piece of inventory is being reduced. Okay, so that's not the way to do it. You cannot do adjusting entry based on just accounting cost of goods sold and inventory asset. It does happen, but not here. So I'm going to close the screen, go back and show you where I went. This is inventory adjustment. You see on top, adjust quantity value on hand. So it's adjustment to the quantity. Sometimes you'll be doing total value, but most of the time, the reason you do total value is because the same quantity just lost value, became cheaper. So sometimes you'll be doing total value. Okay, so here you have cost of goods sold, and here it says wood door exterior. So this is a journal entry that's touching inventory for sure. Okay, I'll save it and show the journal entry. Accountant and taxes, journal. And right now I just want December 31, one day to show you December 31. Okay. So on December 31, I also paid taxes, but that's not important. So you have your cost of goods sold and inventory. I'm going to try to stretch this and close this. Okay, so this is a journal entry I just did. You'll see it's called inventory adjust, 61701, 61701, cost of goods sold, inventory assets. But it really went to the specific inventory. So if I go back here, not to inventory activity, just to items and services, and you ask me how many doors, exterior doors I have, it's going to show the correct value. We have 13 doors. I probably would have done more of an adjustment because the price was wrong also, but that's good enough for now. Okay, so anytime you do physical count and the items are wrong, you have to adjust it. So to get the physical count before at the end of the year, you go to inventory and you ask for physical inventory worksheet and you print it out and you give it to the people to count. Anything on this schedule, of course, not the main accounts, the sub accounts, is going to be counted, signed, then an accountant sees that they counted and have all the quantity. After he signs it, then fix the adjusting entries. If, let's say they have only 420, so they lost one. Okay, so we adjust. Standard interior brass doors, if they have only 220, 26 pieces, we have to inquire what happened to them. So we have to fix everything here. So physical count is the number that they count, and this paper is signed by two people. It's signed by the accountant who sees it, and the physical person also does the physical count. So usually companies that are very busy at the end of December, December 31st, they don't do physical count on December 31st. They close the business most of the time in February because it's a slow month, and they don't do a calendar year, they do fiscal year. So they doesn't have to be on December 31. Okay, so some companies choose to work on a holiday and count, physical count, and then adjust a little bit only in December. So they might do even Thanksgiving Day count, and they pay employees to work on Thanksgiving, but the business is closed if they do want physical count. Okay, so it depends on the style of the company. So this is your physical count. Take the physical count and go to, again, the home screen, inventory activity, and this pull down, this triangle means you have more. Adjust quantity value on hand. That's where you would go for adjustments on quantity of inventory only. Okay, so now we're going to go into, okay, I think I finished this PowerPoints that I wanted to show you. Okay, I'm sharing now another PowerPoint and we're going to discuss adjusting entries. Double check that you see what I see. Okay. Adjusting entries and financial statements. Then always the step is first create adjusting entries and then you can print the financial statements. The financials are incorrect, they're not up to date before adjusting entries. So remember, some companies do it semi-annually, quarterly, annually. You don't have to wait. Some companies only do it once a year, so December 31st, if it's a calendar year. And some companies have it automatically, even done every month. So it's better if it's done monthly, but at least once a year, it's required from every company. Okay, so we know we're going to be doing accrual. We're not going to do cash. Cash basis is not acceptable according to GAAP. We're doing accrual basis, which means revenue recognized when earned and expenses are recognized when incurred. So we want to check that all the expenses for the month of December are in. We want to check that all the revenue we earned were billed. So we sent an invoice. The first example is insurance that we prepaid. Okay, over here you have 2,400 for 24 months. It's not important the year, but the policy was 2013 and it's going to be until 2015 because it's 24 months. So the month of December for 2013 needs to be adjusted because it's 1 month from December 1st to December 31st. If you will tell me to adjust the whole 2,400, it's totally wrong. It's 2,400 is for 24 months. So 2,400 has to be divided by 24, and then you will discover that the insurance for that month is only $100. So we have to divide it. $100 is for December. Next year is the whole 12 months. And in 2015 is only 11 months. So the way we're going to adjust, it's $100 only to insurance expense, and we're going to reduce by credit prepaid insurance. So that's what it means, accrual basis. We're going to recognize only what happened in every year. So 100 because we paid for December 1st to December 31st expired. 100 expired for this current year. Now the next year will be 1,200, and the year after is going to be 1,100, and then you pay probably here in December again 2,400. Okay, so that's called the matching principle, and we match the expenses to the same, matching the expenses for the period. So adjusting framework. If you paid cash before expense, recognize. If you paid cash after the expense, recognize. So we would have, if you paid before, that's called prepaid, or unearned. I'm paying you money in advance to take my case to the court in 3 months. That's definitely deferred. It's definitely you didn't work for it. Because you're going to work in March or April of 2021, I paid you now as an advance payment just to make sure you will be available for me, but it doesn't mean that you worked for it. So we just booked that date. And that's called unearned, and it causes a liability. You owe me the money or the work. Okay, so paid cash after expense, accrued revenue, before, after expense or revenue were recognized. So you paid cash after the fact that it's, an example would be salaries payable, and you're sending cash, salaries paid. So maybe you wrote by Thursday that it's salaries payable, the next day you paid it, but it's a different year. So you have to write it down because you owe people money, and the expense should be recognized. Okay, so deferred expenses example is the insurance prepaid, 24 months insurance that was prepaid in advance. So the resources means resources is the cash. Cash is paid for prior to receiving the actual benefit. I'm paying you 24 months in advance, but you did not get 24 months of insurance yet. You only got from December 1st to December 31st, if today is December 31st. So only 1 month expired. So you have to remember the unadjusted balance would be 2,300, and you're moving 100 over here. So your balance will be 2,300 here, and an expense, which is a temporary count, realizing the expense, which is insurance expense. That's the first example. So second example is something that we use all the time. To make your life easier, in QuickBooks, write the name supplies on hand. Always when I'm telling my people I work with, that the word supplies on hand will not confuse you. Because some people think supplies is always an expense, which is not true. Supplies on hand, it means in supplies that you have, like pen, pencils, whatever, that you're going to have it until you use it. So you're holding it until you use it. You purchased and put it in your closet. That also needs to be counted at year end. So we have to physically count your supplies and see if you still have supplies. So this company purchased 9,720 of supplies during the year. They record the expenditure as supplies. So which means when they use, they still recording supplies. So on December 31, the count of supplies indicated 8,670 on hand. So we know that there is a difference between 9,720 to 8,670 that's still here. And the difference is 1,050. So which means they did not record the expenditure. They didn't write down supplies expense yet. So we have to do the difference and correct our supplies, because my supplies on the balance sheet will show 9,720. It's incorrect. I cannot sign for 9,720 when you have only 8,670. So we need to reduce the supplies to be the right number. So you see the account number is 126, that's your asset. Always is called supplies on hand. Supplies on hand will be used, and we're going to reduce it to the correct number. So we're reducing by doing a credit of 1,050, the difference, and the difference moves to supplies expense. So now we recognize the expense for the year. And you still have supplies, but now it's correct balance. So now the supplies on the balance sheet will be correct balance of 8,670, and the supplies expense, which is a temporary account, will be correct on the profit and loss. So what's the adjustment? Again, credit and debit. So we need debit first to supplies, which is an asset, and credit supplies expense is the debit, and credit to supplies on hand. Okay, so we're recording the supplies being used. Now, usually this is the correct way. Some companies, I come in and the whole year they only use supplies expense, every time they buy everything from Staples. So then I come and ask them, do you have any supplies closet? Sometimes they come and show me a whole room. This is my supplies closet. So the supplies closet has a value of, let's say, 10,000 in there. And you wrote the supplies expense is 120,000. So I need to move opposite from supplies expense to supplies as an asset. And I'll call it supplies on hand. Because again, you really made a mistake because your expenses are over and then your profit is lower. So you really want to correct it because your asset is not recognized. You have assets of supplies that you technically could sometimes return. So all these reasons you need to do it. So if you saw this entry opposite, it depends on the company. So if the company whole year used supplies expense, I would move it at year end to supplies on hand. So you've seen that in the book as well. Okay, basic depreciation. So you must know depreciation, straight line, just a quick review. Asset cost minus salvage divided by useful life. So that's going to be given to you. They will say asset cost is 10,000 minus, let's say, salvage value of 2,000. Useful life is 4. So we do 10 minus 2 is 8. 8,000 divided by 4 is 2,000, and I'm going to have a total. Okay, that's how we're going to divide it. Here's the example. They bought for 62,000 equipment. Equipment useful life, we need this information. It says 5 years. They expect to sell the equipment at the end of its life for 2,000 in cash. That's the salvage value. So you would be doing 62 minus 2. And we go back to the important information. Useful life is 5. So 60 divided by 5. And that's going to be your depreciation expense. Okay, so the answer is 12,000. 62 minus 2 is 60 divided by 5, it's 12,000. This is your annual depreciation. If I ask you for your monthly depreciation, again, you're going to divide by 12 and say every month $1,000 on this equipment. Okay, so we're recording depreciation expense and accumulate. This entry you must know. Depreciation expense is a temporary account. Accumulated depreciation is the contra asset account. So you need to see depreciation expense on your profit and loss. You need to see accumulated depreciation on your balance sheet. If you're recording it once a year. Now, what you could do on the computer, this type of entry repeats every year. So I could tell the computer that I'm needed to repeat every year, and even sometimes tell the computer to do it by itself and memorize it. So I want to show a little bit extra. I'm going to stop right now. I'll show how we do it in QuickBooks. Okay, so today we're talking about adjusting entries, and I'll show you how we automate things. We go over here. Again, it's accountant. I hope I'm sharing the right screen. Okay, good. Okay, so I'm discussing depreciation, accountant, make general journal entries, It is definitely an adjusting entry, so let the computer do this check mark, adjusting entries, and it's December 31. Okay, so we'll take an equipment. I think I have. Okay, we're looking for assets that will depreciate. So the assets that will depreciate, first of all, are all under fixed assets. Furniture and equipment, vehicle, building and improvement, construction equipment. Of course, land does not. So that's one we skip. We're noticing that this is a corporation. They set it up that they have one accumulated depreciation only to all this group, to furniture, to vehicle, to building, and to construction equipment. So let's assume we're doing construction equipment. So the first entry is depreciation expense. And I could do this math over here if you want. 62,000 minus 2,000 equals 60,000. And we're going to divide by 5 years. And we got 12,000. Okay, so 12,000. Now, the sale is also the same way. It works as a calculator. 62,000 minus 2,000 is 60,000. And we could take the 60,000 and say divided by 5 years. And you see it's 12,000. Okay? If you didn't understand, it's again 60,000 divided by 5 years, enter, you get 12,000. So this, every cell in QuickBooks is really a calculator. You don't need to get out. You don't need to press any calculator. It used to be on top when you had the old version of QuickBooks, there was a calculator in. So depreciation expense, and the second line we say accumulated depreciation. Okay, this is straight line depreciation. So if I want this to be done, straight line depreciation, and assume this is the first year. So I can do it like this. Okay, you have view, no, go to, first you can memorize, but yeah, let's do memorize. Before you're saving even, you're doing this. You could do right mouse click and memorize this transaction. Okay, not duplicate, memorize general journal. You also have it from up here, edit, memorize general journal. Shortcut is control letter M. This is what you got to get. So memorize the transaction. I'm going to call it depreciation equipment. And I like to use, I really like the reminders. I don't want it to be done automatically, but I'm going to teach automatic. So automate transaction means that, and the reason I don't like depreciation to be automatic is because some equipment will not even last the 5 years. Remember, this is a very abstract type of an expense because the whole depreciation is based on forecast and what if it would last 5 years. But you might have this machine and it's really a lemon and after 2 years it blew up. Or you might have the machine only lasting 4 years, not 5. So, and it's not worth it to fix anymore. So you will have zero salvage. Many things can happen. That's the reason I do not like to just let the machine automate it and do it himself because you'll forget about it. But I'll teach automated anyway. So automate the transaction because it's going to be done once a year. So I'm going to write down instead of never, annually. Next one would be, remember by us is 22. So next year is December 23. It's just faster to type 23. And how many years will be remaining? So the total is 5. So that this is going to be number remaining is 4. If you want it to be done instead of December 31, even on December 26, let's say, you will say 5 days before. So days in advance to enter it. So you for sure would have it before the end of the year. That's how you would automate. And you say, okay, sounds like a click of a camera. And it's saved, it's memorized it. But it's not doing it now because it's until December 31, 2022. I prefer that you would do it usually the same way, but instead of doing automate, just choose reminders. And it will remind you by the end of the year, you need. So I prefer reminders. What we just did, memorize, did not save your work. You have to still press save and close. And then you'll see it here that you have a cumulative depreciation. Okay, you don't really see it, but the number increased in here. It's in here, cumulative depreciation, 12,000. This is a journal entry I just did. Depreciation expense is always debit, cumulative depreciation is credit. Now, if I decided to do it as a memorized, you need to know where it is. It's under list in menu, and you go down to memorize transaction list or Control T, and things are there. Okay, let's see what's there. So I did depreciation and it's automated. Recurring depreciation, you see, that's another reason I didn't like to do it. This one is done monthly, $19.60 every month. Discount. It's not really doing much. If you're realizing here, the accounts are the same, debit, credit, but it's just to apply it to the correct person, to apply to the name. So that's not important. Okay, let's look at another example of something they memorized. Overhead. Okay, here's a good example. Overhead, and they said here, prepaid insurance. So I know this is an adjusting entry. So let's look at it. Yep, this is an adjusting entry. Okay, that's an adjusting entry because they need to allocate the prepaid insurance to the expense. The exact definition of it is first debit all the insurances, which you're doing here, and credit prepaid insurance. So this is done monthly. Okay, let's do it for December 31. So prepaid insurance, you see, is getting a credit of 675. And the debits are going individually into each insurance expense, to work comp, to liability, to disability. So it's divided right. So that's our example. So prepaid moving to insurance expense. That's what we saw before. Okay, let's continue. Okay, other insurance. Let's make sure that you share again. Okay, so we talked about depreciation, and the entries for depreciation is gonna have definitely affect, because we did accumulate, it's gonna look like this at the end of the year. All your fixed asset together minus the cumulative depreciation, and it will give you a total. That's what you're gonna see in QuickBooks. Okay, it's better for us to do it individually on each one, and then you'll see this is the book value of my equipment. But it's also correct, the style of this corporation, that they do all the fixed asset together and accumulate, excuse me, one shot. Okay, the reason is, if they do it that way, that you have one accumulative depreciation, they need to keep track a complete different Excel spreadsheet of depreciation, up to date, book value, all of it. So you will not get the answers on QuickBooks. You will have to get it from an Excel, because if I would ask you book value on each item, you won't be able to do it. Okay, so unearned becomes earned. You got in advance money for, like example, you paid in advance for season tickets, and you have to go to basketball games. So sometimes there are 4 games, 10 games, I don't know how many basketball games, but you paid in advance, and they're responsible to give you the service. So unadjusted balance will get reduced, and that's debit, it's reduced, and the revenue increases after each game. Okay, so on October 1st, this university sold 1,000 tickets to 20 home basketball games, $100 each. So there are 20 games, $100 each, and it's 1,000 tickets. So you multiply all that, 1,000 times 20 times 100, and you're getting 100,000. So cash was received on October 1st. They did not earn it in October because the games are in October, let's say 15, and in November, and in December. So we will have to examine how many games were between October 1st to December 31st. And then you move it. Unearned is a liability. You owe me the money. So the whole season, let's say canceled, no games, you have to credit all the money back. Okay, so unearned becomes earned. After 10 games, I don't care who won or lost, doesn't matter for us, we're just saying the 10, half the games are provided. So 10 games are provided, it's going to be unearned reduced by 50 and revenue increases by 50. Cost incurred for the period is accrued expenses and are both unpaid and unrecorded. Okay, so we have to recognize it, debit the expense and credit the liability. Examples of those are salaries expense, salaries payable, interest expense, interest payable. I didn't say to pay it, I just wrote to know that you owe. You have to record that it happened. So this employee is saying we're half done with our job, but we want to be paid. So salaries are going to be paid usually on a Friday, and this is a common example. If you pay on the Friday, but the year end falls on Thursday, so you need to punch like really, if you're doing by hourly, the employees get a new record on a Friday, completely like new because it's starting the next year. So the employee have earned salaries of $47,250 from Monday through Thursday. You owe them $47,250, but you're paying them tomorrow. So you need to recognize that you owe $47,250, and then you pay next time on January 1st, which is a Friday. So you need the adjusting entry right here on a Thursday. You're not telling your employees, wait, you're getting two paychecks, one on Thursday, one on Friday. No, we don't do double. We're just doing the payroll on Friday, but we know we owe the money on Thursday because we want to close the year. So when you do December 31 year end, the purpose of it is to make your W-2 correct and accurate. Whatever your salary for the year, that will show on your W-2. So we recognize the expense. Salaries expense, $47,250. Salaries payable, $47,250. And on Friday, when you pay it, it's going to be, let's say, $50,000. You're going to pay in cash, but salaries expense will be small amount. Salaries payable, $47,250, and the $50,000 going to be in cash. And this is called accrued. It means it happened, but I'm not paying yet. So accrued is the salaries incurred, it happened, but I didn't pay it until Friday. So here's an example of $31,200 of work completed, but not yet billed. So you're the CPA, you decided that you worked, you checked your whole December work and billing hours. You have to bill customer for $31,200. I didn't call them and say, please pay me today $31,200 because it's December 31. We just recognize that it's December 31 and you owe us the money. So it's always account receivable. You sending invoices to recognize the service revenue that you earned it. If you didn't, your revenue will be too low and it's wrong for profit and loss. And also the balance sheet will be affected. You'll be short by $31,200. That's shifting the income to next year if you build it only on the 1st. So you have to be careful with your dates. This belongs to last year. The service we worked for, we're going to send the bills. I will provide you all these PowerPoints on Blackboard. So here's a summary of all the adjusting entries: prepaid expense, unearned revenue, accrued expense, accrued revenue, and how it should be adjusted. Okay, expenses are debits, the assets are going down, and liability goes down. If liability goes down, revenue goes up. Okay, so this is what adjusted trial balance, if you're still looking at it. The next is adjusted trial balance, that basically it's a worksheet. We check the trial balance and we do it usually on Excel. We take from QuickBooks the trial balance and we write down the adjusting entries on Excel. And then we come back and recognize them and really record them. So if you do adjusting entries on a paper, on an Excel, it's like you're doing it on a paper that you can throw it away. You have to remember to actually do journal entries on the computer, not just on a piece of paper, because it's not going to be in your system. So your general ledger has to be up to date. Okay, so this extra paper is really adjusting entries. You will double check from here and do them. If you're doing it on Excel, fine, but it really needs to be recorded from the worksheet to actual adjusting entries. Okay, so in this example, I could right away say they're probably missing accounts receivable. They forgot to bill people. I would have to check supplies. It's still really 9,720. I have to check prepaid insurance if nothing expired. And the equipment over here of 26,000 if there was no depreciation. See, it's zero. If they have an asset, there's usually depreciation. So already I know a few adjusting entries that's going to happen. Then I see over here also unearned revenue of 3,000. I have to check if it was earned. Depreciation is zero. Supplies expense is zero. They will not stay in zero for long. So here's the example. Accounts receivable, we billing 1,800 and income goes up by 1,800. That's letter F. On A, prepaid insurance goes down by 100. Insurance expense goes up by 100. You're seeing the little a. Okay, B, 9,720 goes down by 1,050. It's going to be 8,670. So it's going to happen here. Okay, equipment 26 minus 375. So the book value is this, minus 375. You're never ever touching the equipment itself unless you're selling equipment. The only time you're crediting equipment is when you're selling equipment. I see this all the time, students doing adjusting entries to the equipment. Never to the equipment, only to the contra account called accumulated depreciation. You're not allowed to touch the equipment unless you're selling. It's not like a piece of the equipment being, ripped off. You're just losing value. So here's the correct number. 9,720 minus 1,050 is 8,670. And it does happen. So we would like to make sure that our adjusting entries are right. But this is an extra paper that you don't have to do it. So if you feel that you don't need and take the trial balance into Excel and work on Excel, so just right away do adjusting entries on QuickBooks. Okay, after you did adjusting entries, you're ready from, there's going to be the adjusted trial balance, and you're ready to work with an income statement. Income minus all the expenses will give you the difference of net income. 8,150 minus all the expenses is 3,785. Okay, statement of retained earning. Retained earning, we always add net income and we deduct dividends. And then you get the new retained earning. So this is done for you directly in QuickBooks on the balance sheet. So this statement is swallowed by the balance sheet. So you don't see this statement alone. Okay, QuickBooks does it directly on the balance sheet. We'll see it on the balance sheet right here. Common stock, return earning, net income, and value of return earning. So they do it all on the balance sheet. And then the last one is cash flow. But that's the correct statement, and only all the statements should be done, including cash flow should be done after adjusting entries. Everything should be done after you know that the adjusting entries were done. Then your correct financials are done. Okay, and the closing is done by the computer. So just definition of temporary permanent, you don't need this. This is a review of closing, okay? Okay, so after closing, you want to make sure that you did it right. You prepare a post-closing trial balance. Remember that QuickBooks does not let you change the titles. It's not going to say the word post-closing trial balance, but it will be short. It'll be only assets, liability, and equity. So you know you're in a post-closing trial balance, or you're in a new, but completely new year. They didn't have revenue and expenses. So that's post-closing trial balance. If your year is the first year operation and it didn't work yet, that's a trial balance that shows assets, liability, and equity. But if you don't see retained earning, zero, that's a new year. If you see for the second year, there is retained earning, it means that the closing was done and you're ready to start with the revenue and expenses for the year that we're following, which is 2023. Okay, so that's very important that the computer closes the books for you. So remember the steps in accounting cycle. You analyze transaction, you journalize, you post, you prepare adjusted trial balance, and you're actually going to do step 5, adjust. After adjusting, you prepare adjusted trial balance. From the adjusted trial balance, you prepare statements. Then the computer closes the books for you, and you can print trial balance. Okay, so we're eliminating some steps because the closing is automatically. So let's look at our balance sheet now. Okay, I'm going to go back to QuickBooks to show examples. Okay, so I'm showing examples of transactions. So again, the first thing I would do in QuickBooks is go to reports, accountant and taxes, not adjusted trial balance, regular trial balance. Take a regular trial balance. Remember, it doesn't matter the date over here. The computer doesn't read November 1st. What he's reading is the ending. So I need the date to be December 31st, 2022. Okay, that's how general ledger works. It's until what date, it's not from what date. Even if I write here from 01, 01, 20, let's say 2000 even. Doesn't affect, even if we were not in business in that year, it doesn't matter. It's not reading this, it's not wrong. This is the correct date, 12/31/2022. If I would say 2020 or 2000 here, okay, that's could be wrong, I'll have nothing because they were not in business. So you need to know what year they opened up. I think they did 20, okay, let's see if 2020. Yeah, 2020, they did open up. There's even a few little expenses. Okay, so 2020, they were in business already. Okay, so that's December 31, 2020. Okay, that's assets, liability, and should be some equity. Let's see the equity. Loans. Yeah, they have some income and expenses. Okay, so I'm going to do 2022 because that's the year we're doing now. That's our sample year. And from this year, I can learn a lot. I could do review of all the stuff that I was talking about. Again, if you missed the beginning of class, you do have help. It's not doing it for you, but it's reminding you what needs to be done. Now go to help in menu, year-end guide, and you will have a guide of what needs to be done. So reconciliation of bank and credit card. Let's discuss that. I go to every account that we have. Over here is checking and savings. Those are bank accounts. Next is petty cash. That says 500. But if in your drawer you have $5, you cannot say that I have 500 on your balance sheet. So it's time to replenish. Okay, so that's what I was talking about. Okay, you could use this practice in QuickBooks Online, exactly like this. You use the plus, and the plus is journal entry. And then you can practice insurance expense, prepaid, any accounts that you want. So all journal entries are always a plus and journal entry. So you can practice that on any QuickBooks Online. Adjusting entries are the same. Depreciation expense and accumulate, same thing as QuickBooks Online. So it doesn't have to be this numbers at all. Okay, so it depends on what you have on the screen. So you have over here Chase checking, and I have savings. Each one of them, I'll go over here, home screen. And of course, we did this in chapter 3 or 4, long time ago already. So you have reconciliation, and you reconcile until the end of the year. Notice that you can reconcile only a few accounts, the bank accounts and credit cards accounts. So you could go to credit card. Okay, this example is, you see November 30th, this credit card. The name is QuickBooks credit card. $25 was the beginning. Let's say my ending is $125. Okay, over here it says finance charge if you owe money, and the date and the account. If you don't have, just continue. Okay, so here we see December 10. That can't be. December 20 cannot be because it's December when we're doing November. So I'm not going to do December. I need another charge of $100 that's missing. So I just have to enter it. I could do go to. We're not doing it really. I'm looking for $100. Okay, so this is the credit card. And now it says credit card is $94.20. After that, I want to do $100. And I'm missing the expense called computer repair, $100. And the date is still in November. I got it November 29. And save and close. Okay, so I just entered this $100. So this $100 was a purchase that I had, and it was missing. So that's the reason I need to adjust. So I wrote $100. Now I'm matching ending balance and cleared balance is $125. I reconcile now. Okay, so then it's asking us, what do you want to do with this credit card? Write a check now or enter a bill for payment later. If you would say cancel, it's the same thing. It's basically doing write a bill for payment later. So you just increased it and you say, okay, we will pay it later. But you have the option of also writing a check right now for $125 for what you owe. So if you say, okay, he's making a check for $125. Change the date of the check. You could pay it December 2nd, whenever. And close. Okay, so I just showed you adjusting entries that are done through reconciliation of credit card. Okay, I'll do another one. So this was QuickBooks credit card. Let's finish it. It's the end of the year. December 31, ending balance, beginning balance is $125, ending balance, let's say $75. Okay, so now I have reconciliation of the $125 that's paid and $69.20 over here. So we're off by $5.80. I'm going to leave. Okay, same one, but I want to add $5.80 as a finance charge. I added interest expense of $5.80. Now that I continue, you'll see that it's $75 balance and it's done. So then again, you don't have to pay it yet. You can do it later and pay it in January, but we just need the books to be accurate. So if I decided not to write a check right now, fine. If I said, okay, I could postpone the check. It's not a problem. So the date of the check would be next month. I can even pay it here. Okay, but at least the balance and everything, the information was for December. It was in the computer. Okay, that needs to be done at year end. So that's the reason I do one by one reconciliation. You click on reconcile, you go to the correct credit card. Let's say you're doing California Oil, same idea. 436.90, you have to adjust all the information in there. Make sure that you're covering the right dates. I'm just doing an example. So right dates will be expenses that are there from this November. And all of these are not from November. No, they're not from November. Okay, so I cannot touch them. Okay, so in petty cash, I'm going into Excel. I'll show you the example. I'm not sure I have a template for that. Okay, it freezes on me. I have no idea why not. Okay, the Excel is not functioning right now. I just want a new. Okay, somehow it's not working right now. Okay, I'll try to share this way. Okay, fine, here, example. Basically, I'm making date. I don't know if it will let me type it even. Okay, let's try now. Okay, it's not activated right now. Anyway, so I'll just go to the explain the journal entry. Okay, so we see that journal entry of petty cash, it stays 500. We're about to finish. I'm not doing adjusting entries here. All you're doing is taking the Excel spreadsheet of what you spent and making a check. So that's very important to do it every month. It's called replenishing the petty cash. So replenish the petty cash means you're basically going to write a check. You never write a check to cash. You're writing it to the person who is in charge of the petty cash. So it's usually an employee. Let's see which employee. But it's not a payroll check. They're not supposed to pay. Okay, let's say I chose Elizabeth Mailer. And it's not a payroll, so do not turn on payroll. You say not now. Whenever you reimburse an employee something, they don't have to pay taxes on this. So Elizabeth Mason, she is the cashier to replenish petty cash. Okay, so we're saying that we have $5, okay, make $3 left in the drawer. So now we're going to go to the Excel and check out what did they spend the whole month. And we're doing it like this. We will say supplies expense. Office supplies. And they spend $170. And then they spend on computer repair, another $150. Then they spend on postage. Postage expense. Let's say they spend $49. And as I'm going on, you'll see that it's increasing the check amount right there. Yes, I have already 3 expenses. If I don't have the exact receipts and I don't have the breakdown, it's not ideal. What's the matter with it? The next is miscellaneous expense. I don't recall the amount, so that's not good. Okay, I'm gonna do find. Find me the check with Elizabeth Mason. Cashier to replace the check. Here it is. Okay, so some of them I left as 0. I have 369. I'm gonna do it at year end, first of all. And I want the amount to be 497. Okay, so let's say $31 is miscellaneous. And another, what's going on here? Why I have this space? I don't like the space. So let me just delete the line. Okay, this line, I want it to be $100. And we spent on equipment rental. Okay. Not income, we want expense. See, I'm very careful with the accounts that I need. So I need equipment rental, and I make sure that I didn't take the 4, I took the 5. That's cost of goods sold. Okay, so now we have 170 plus 150 plus 49 plus 100 plus 31. And the amount should be recalculated. Okay, so this is the full 500, but I'm wrong. It should not be 500, it should be. Let's recalculate again. 497. Now, what's the reason it's 497? Because we have $3 still in the box. So $3 plus 497 that I just have expenses with receipts, of course. And that's the equals to the 500. We replenish the box. So now the balance sheet could say 500. Now it seems like it's a waste of my time on 500 little petty cash, but I could do petty cash with much more money. So I did petty cash with a few $1000s. So it depends on what they use it for. Of course, it needs to be a person you trust. So Elizabeth Mason and somebody else signing for every time they take money. They want to make sure that the $28 is not one lunch for her. So it's used by the business. Okay, so the more notes you write, the better it is. With permission, with slips. So they use the vouchers for petty cash. If I constantly see problems in petty cash when I do an audit, it's a red flag. Many times, like if you would have over here every month, $100 equipment rental and no receipt, that's a red flag. Maybe that's your $100 that you pay for an illegal worker in cash. That's the reason you don't have a receipt. So many things can be hiding over here. Okay, so that's the example of petty cash. And remember, petty cash is being audited most of the time right away, like in the beginning of an audit. Okay, so this is petty cash at the end of the year. And now December 31, all these expenses are going to affect my income. So all this is expenses. Okay, so now I'm going to review with you again. You go to help, year-end guide. So we did A and we did B. A, reconciliation of all bank and credit card accounts. It could take much longer than what I just did. And verify the petty cash entries for the year. Make the year-end accrual adjustments. And you still have to do review details of the new equipment to make sure what you purchased, and make all assets depreciation and adjustments entries. Okay, so sometimes you'll have to be an investigator if you don't have information. I'll show you what I mean. I could balance sheet for 2 years and figure it out if they bought anything. So I take balance sheet. If you're looking at 1 year, you're not going to see it. But when you look at 2 years, company financial, balance sheet from previous year and this year comparison. So December 31, I look at the comparison. I have a vertical, no, this time it's horizontal. And I'm looking at fixed assets only to figure out if they bought anything. Okay, so here's my answer. Furniture and equipment, last year was 2021. This year is 2022. 22,826 was last year. This year we have equipment of 325. Oh, it's 326. So it's 11,500 went up. So this is a new equipment that will need depreciation. If I didn't see any depreciation here, I can investigate last year. How much was depreciation expense last year? So right now I see the difference was 12,000. But we need to know more, and you cannot just assume that way. But definitely this 11,500 needs to start depreciating. It means you added equipment. Okay, so I want you to read carefully chapter 9. And on Blackboard, you would have the PowerPoints that I just used. So the PowerPoints for adjusting entries. And also I'm posting another one called Petty Cash Funds. Here's the example of petty cash. Some of you would know it, some of you don't. So I started talking about it last time, voucher system and small expenses petty cash. So petty cash is the cashier, and then the petty cash cashier gets the money. That's when we initiate. Over here, example 400. You don't touch the petty cash fund, you just replenish the checks, which means that she uses the money. She uses the money from that box. She would have receipts, or he would have receipts for the postage courier, okay, $80, and he bought stamps for 45. So these two is spent. That's the money he spent. So he only needs to replenish what he spends, $80 and 45. Okay, so these are receipts that goes in the box, and you know what to spend the money for. Of course, no further, it should not be any forgeries. Everything should be signed and pre-numbered. So we have receipts for 125. Here's your journal entry, postage expense, delivery expense, and cash. So this done monthly, but of course at year end, you must do it. Now, if you don't have a receipt, you can go to, use miscellaneous expense, but not on a large amount. Use cash short and over for a couple dollars that you short if you didn't give the right change. So I'm posting for you these petty cash examples and review petty cash as well. Okay, good luck. So this is chapter 9. Chapter 9 on Connect is very short. You just have to do adjusting entries. If you're doing QuickBooks Online, just practice something like this. A journal entry, you're doing a plus journal entry, and you're practicing a journal entry. It could be done as a check, or it could be done as a journal entry.